Swart, Phillips, and Weinberg, and I will have the pleasure to be your host and moderator for this session that will essentially consist in a comparative study of the Canadian foreign affiliate rules and the European controlled foreign corporation rules. For this discussion, I'll be joined today by Charlotte Haarsma-den Dekker of Loyens and Loeff in Luxembourg, and Andrew Morreale of Baker McKenzie in Toronto. Just before we get started, there's 3 housekeeping items that I'd like to go through. So item number 1, we'll try to keep this discussion at about 50 minutes, following which we will have a Q&A session. So if you have any questions, you'll see there's a box on the right side, so bottom right side of your screen. It's called Q&A. So if you want to have a question, ask the question there and make sure to send it to all the panelists so we can all see it. Number 2 is just to briefly discuss the big elephant in the room with respect to those rules, which is Pillar 2 of the OECD inclusive framework on base erosion and profit shifting. So Pillar 2 will not be discussed today, given that we really wanted to focus on the comparative study. But if you're interested, Global IFA is holding its annual congress on between November 29 and December 1st. And the session, or the whole congress, will be strictly on Pillar 2 and Pillar 1, which are both part of that inclusive framework. So I encourage everybody to go register for that event, which will be free for all IFA members. Which brings me to my third point is if you're not an IFA member, I strongly encourage you to go and register. It's between $70 to $195 per person. It's really cheap and it's probably the best investment that you can make. And last thing, we also have corporate memberships. So it's even better if you're a big organization like the CRA or any of those big companies that could benefit from that corporate membership. So with that said, I'll pass it on to Andrew.
Great, thanks. Good afternoon, everyone. I'm just going to add one more exclusion to the list of topics we're not talking about, and that's the MOI. Kind of that along with the OECD proposals really could be seminars of their own. So I think we'll leave those out of the discussion today. So to get started, I'm going to kind of go through a quick overview of the Canadian CFC rules and concepts. The goal really is to provide an overview of how these different systems work and to highlight some of the differences between the Canadian approach and the approach taken in the EU. So kind of the very first question to address is what is a CFC under Canadian rules? And the Canadian CFC rules are generally comprised of 2 overlapping but separate sets of rules. The first being the FAPI regime, which generally is an anti-deferral and Canadian tax-based protection mechanism that broadly targets passive income. The second being the surplus regime, which generally governs the treatment of distributions from the foreign affiliates of Canadian corporate taxpayers. In practice, these rules are rather complicated as a result of the differences in Canadian and foreign tax, as well as from the ongoing legislative amendments that have introduced additional provisions and measures that target perceived abuses. In the next couple of slides, I will attempt to cover the underlying concepts in the 2 overlapping regimes as to provide a basis for comparison with the approaches used in the EU. So the first kind of underlying concept is that of what a foreign affiliate is. So foreign affiliate status of a non-resident corporation is generally a good thing, as it allows the non-resident subsidiary of the Canadian corporate taxpayer to benefit from the surplus regime, which provides relief on distributions from CFCs by way of full or partial deductibility, depending on the type of underlying income and where it is earned. I'll cover this a bit more in subsequent slides. Foreign affiliate status is determined in respect of a non-resident corporation in which the Canadian corporation has an equity percentage of at least 1% of any class of shares, and the total equity percentages of the taxpayer and related persons is at least 10%. This determination in respect of the non-resident corporation is based on the effective equity interest in the non-resident corporation the Canadian corporation has on a look-through basis. So somewhat simplistically, if the Canadian taxpayer can, on a look-through basis, have at least a 10% equity interest in the non-resident company, it will be a foreign affiliate of the Canadian taxpayer and find itself subject to an overall beneficial foreign affiliate surplus regime. So in the illustration here, assuming Lux Holdco only has one class of common shares, if the parent company has at least 10% of those shares, Lux Holdco will be a foreign affiliate of the parent company, i.e. the company that's resident in Canada. Controlled foreign affiliate status, on the other hand, may be less favorable to Canadian taxpayers, as it subjects the Canadian taxpayer to inclusions of certain passive income, more on FAPI in subsequent slides, earned by that CFA into the Canadian taxpayer's income, whether distributed to the taxpayer in that year or not. The test for controlled foreign affiliate status is very broad, as it effectively involves monitoring who the other shareholders of the foreign affiliate are and can extend beyond obvious de jure control. It includes any foreign affiliate that the taxpayer controls, as well as any foreign affiliate that it would control if the Canadian taxpayer held all of the shares by persons that it does not deal at arm's length with, and up to any 4 other persons resident in Canada, whether related to the taxpayer or not. So in the most basic example, as illustrated here in the slides, if Lux Holdco is a wholly owned subsidiary of Parent Co, it will be a controlled foreign affiliate of Parent Co. And again, assuming EU Co and any of the non-EU Cos are wholly owned by Lux Holdco, they will also be controlled foreign affiliates. The result of this is they're going to be subject to both the surplus and FAPI regimes. The next question, kind of relevant, still on the former slide there, in respect of foreign affiliates, is where that CFC is resident, as this will impact both the current taxation of any income earned by that affiliate, as well as the characterization of any surplus generated, and as a result, the treatment of distributions made to the Canadian corporate shareholder. There are effectively 3 categories of residency generally applicable to foreign affiliates that are resident in a designated treaty country, or a DTC. This category includes any country with which Canada has a comprehensive tax treaty, tax information exchange agreement, this category is fairly broad and would cover off most EU member states. Second category is foreign affiliates that are not resident in a DTC, as compared to foreign affiliates that are resident in a DTC. Effectively, any active business income earned in a DTC can be distributed back to Canada on a fully deductible basis. In respect of foreign affiliates that are not resident in a DTC, the distribution of income earned, really, the deductibility depends on the level of foreign tax paid on that income. Foreign affiliates in countries that are in a non-qualifying country are quite rare. This category includes any country that is not a DTC and not subject to the OECD Convention on Mutual Administrative Assistance in Tax Matters as in force. And that country has been invited to start negotiations for a TIA or into the OECD Convention, and has not concluded that after 60 months. I think there was a question about that. So the question I'm coming around to is whether you indicated there are only a few non-qualifying countries where any income earned will be FAPI. Can you provide a list of those countries? So I think I covered that on one of the following slides, that right now that list is very short. It only includes Liberia. And even at that, that may change shortly. Liberia has signed on to the OECD Convention on Mutual Administrative Assistance, but it's not yet in force. The practical implication, though, of this is perhaps limited in respect of Liberia, simply because the income that's picked up as FAPI will be subject to a current offsetting deduction for any foreign tax. A quick look kind of shows that their foreign tax is at a level that if the FAPI tax base is equivalent to the Liberian tax base, no net current inclusion will arise. And then similarly, kind of previously taxed FAPI is able to be returned to Canada on a tax-free basis because it was already taxed kind of in the year that it arose. Obviously, that statement there depends on the tax base being similar in both jurisdictions and somewhat assumes away any foreign exchange implications. Onto the So the next topic that I mentioned there is FAPI. The Canadian CFC rules very generally distinguish between active business income and income from property. The FAPI regime generally targets passive income earned in foreign affiliates and generally includes income from property, which includes passive income such as interest, rent, royalties, dividends, income from a business other than an active business, which generally is a result of certain anti-base erosion rules targeting activities by non-resident subsidiaries of Canadian companies. FAPI is generally computed using Canadian dollars and Canadian rules. This can result in differences in income as compared to the computation of income under the foreign law. For a controlled foreign affiliate, FAPI is included in the income of the Canadian parent company on a current basis, with relief for any foreign tax, referred to as foreign accrual tax, paid in respect of that income, which can be applied against the associated FAPI inclusion. You cannot use FAT to offset any other sources of income, i.e. if the FAT exceeds the FAPI. And the reason for this is that FAT is grossed up based on the relevant tax factor, which currently is 4. So effectively, if the controlled foreign affiliate is subject to foreign income tax exceeding 25% on that FAPI, assuming similar Canadian tax base and no foreign exchange issues, that FAPI will be fully covered by an offsetting deduction. Whereas FAPI earned by a foreign affiliate, as compared to a controlled foreign affiliate, will not be included on a current basis, but it will impact the surplus characterization of that income earned by that foreign affiliate. As mentioned, previously taxed FAPI can generally be returned to Canadian corporate shareholders without further Canadian income tax. One other point to note is that FAPI excludes dividends from other foreign affiliates. So the next set of rules that is kind of relevant to this conversation of the Canadian CFC rules is the ability to recharacterize income from transactions between affiliates. These recharacterization rules are generally beneficial to Canadian companies. Without diving too much into the mechanical application of these rules, in effect, they allow income earned by entities such as financing companies or companies holding intellectual property to recharacterize income that would otherwise be passive income into deemed active business income, and thus not FAPI. So a quick illustration here, assume that EU Code 2 carries on an active business and a DTC, say widget manufacturing. EU Code 1 finances this entity with an interest-bearing loan, generating interest deduction and interest income in EU Code 1. This deemed active business income is beneficial as it'll be deemed to be active business income and not FAPI, so it will not be taxed on a current basis and is likely added to the exempt surplus of EU Code 1 and thus can be distributed back to the Canadian corporate shareholder on a fully deductible basis. So the next set of rules that's relevant to talk about is the rules applicable to distributions, which generally is the Canadian surplus regime. The surplus accounts or pools can have a balance, including nil or be in a deficit. they generally track the income that's earned by the foreign affiliate in the foreign jurisdiction based on what type of income it is, i.e. active or passive. Generally subject to some ordering rules and anti-avoidance rules. To the extent there are positive balances in the surplus accounts, they can be distributed from that particular foreign affiliate. Deficits generally need to be overcome before distributions can be made on a deductible basis. And the way that deficits are generated is generally by tax loss transactions in the foreign jurisdiction or by operation of the Canadian CFC rules. Another point to note, kind of looking at the structure here, for example, if EU Co pays a dividend to Lux Holdco, the character of that, the surplus character of that distribution will be maintained. So assuming a nil balance in Lux Holdco, a dividend of $100 from the exempt surplus of EU Co paid to Lux Holdco will result in Lux Holdco surplus increasing by $100 and EU Co's surplus decreasing by the same. Similarly, if Lux Holdco had a deficit of, say, $75 the dividend time, then after the $100 dividend, it would only have a surplus balance, exempt surplus balance of $25. Exempt surplus generally tracks active business income earned in the DTC, as mentioned before, whereas taxable and hybrid surplus track different amounts of income, taxable generally tracking FAPI, and hybrid tracking dispositions of foreign affiliates by foreign affiliates. The surplus rules in respect of taxable or hybrid surplus generally operate to result in overall taxation on the distributed income at a level similar to the Canadian corporate tax rate. Thus, if the foreign tax is less than approximately 25%, the deduction will result in a net inclusion so that the incremental tax paid once distributed results in the total tax being approximately equal to Canadian rates, i.e. around 25%. That rate does not necessarily track the rate paid by the parent corporation in terms of overall deductibility. It's simply a function of how the gross up mechanism works for taxable and hybrid surplus distributions. Relevant to the distribution of taxable and hybrid surplus are underlying foreign tax and hybrid underlying tax accounts that parallel those surplus accounts to track the associated foreign tax for these accounts. It is possible to disproportionately distribute underlying foreign tax, but not hybrid underlying tax. Another point to note, looking at the example here, in a holding company scenario, it is possible for these tax pools to collect in the holding company and blend effectively. What I mean by that is distributions of low taxed and higher taxed amounts can be put together to provide for increased deductions on distributions to the Canadian corporate shareholder. These different accounts are broadly outlined on the next slide with common examples and the general treatment of these amounts on distributions to the Canadian corporate shareholder. So as mentioned, exempt generally includes active business income. Taxable generally includes income that's earned by the affiliate that is FAPI. Exempt is going to be should be fully deductible to a corporate shareholder resident in Canada, whereas taxable will be included with a deduction for the underlying foreign tax. The additional account that we haven't spoken about is pre-acquisition surplus. There's a star next to that amount on the previous slide because this is somewhat of a residual concept and not an account having a balance. Effectively, where there are no other surplus amounts, the distribution can be from pre-acquisition surplus. These distributions will be fully deductible with a corresponding adjustment to the cost base of the shares. If the reduction exceeds the basis, then a capital gain will arise. So the last item to kind of give an overview of the Canadian CFC rules is the treatment of distributions in the CFC context. So where a foreign affiliate disposes of the shares of another foreign affiliate, the Canadian tax treatment will depend on whether the disposed shares are excluded property. The shares of a foreign affiliate will generally be excluded property where all or substantially all, so approximately more than 90% of their fair market value is derived from property that itself is excluded property. So assets of that foreign affiliate would be property that is used or held by the foreign affiliate for use in an active business, or is shares of another foreign affiliate that themselves are excluded property. Dispositions of excluded property are not subject to current Canadian taxation, and the proceeds can be distributed as 50% deductible with an additional deduction for foreign taxes. Effectively, if the gain is subject to foreign tax similar to the Canadian rates, the gain will not be subject to additional Canadian taxation on distribution. Whereas if the gain is lightly taxed in the foreign jurisdiction, these proceeds would be included on a net basis in income in Canada if distributed. But if they aren't distributed, the proceeds can generally be reinvested in other foreign affiliates with no additional Canadian taxation until such time as that associated surplus is distributed to Canada. Dispositions of foreign affiliates that are not excluded property by a controlled foreign affiliate will be FAPI and thus subject to current taxation, whether or not the proceeds are distributed with an offsetting deduction, again, for any foreign taxes paid. The disposition by a foreign affiliate of a foreign affiliate that's not excluded property will not be subject to a current inclusion, but will impact the surplus determination in respect of that disposition. Additionally, one other rule to keep in mind when considering the treatment of disposition of foreign affiliates by foreign affiliates is that it's generally possible to use the surplus attributes of the disposed affiliate to reduce the gain, i.e. if there's a exempt surplus balance in EU Code 2 is illustrated here, it's able to be effectively treated as a deemed dividend, reducing the gain and elevating that surplus to EU Code 1. So that concludes kind of a high-level overview of the Canadian CFC rules. I'll turn it over to Charlotte to kind of pick up on some of the EU portion.
Thanks very much, Andrew. Just in advance, for all of the participants, I have developed an enormously annoying cough, so I do apologize in advance, and I try to keep that under control. I will give a brief overview of the European rules with regards to CFC rules. On the one hand, I'll show that there is a unified approach on the basis of the Anti-Tax Avoidance Directive. On the other hand, I'll also try and give a little bit of an insight on some European jurisdictions which may prove that effectively, although there's a unified approach in practice, there are still quite a lot of differences between the various CFC rules in the various European member states. So in Europe, the CFC rules, although some European member states had already implemented CFC rules as early as the 1980s, in the years 2015-2016, these rules became incredibly more important on the basis of the BEPS action plan, which was followed by the European equivalent of that BEPS action plan, which was the Anti-Tax Avoidance Directive 1 and 2. CFC rules were initially part of the European CCCTB proposal. Perhaps some of you are familiar with that proposal. It was an attempt by the European Commission to actually unify the tax system within the EU. Well, that proposal never got implemented, but instead CFC, together with a few other rules initially included in that CCCTB proposal, were implemented by way of a separate directive, being the Anti-Tax Avoidance Directive 1. This directive was implemented as per 1st of January 2019. And CFC rules apply even though it is a European directive to both third country as well as EU CFCs. So that's where the interesting link with third countries came from. The effect is to reallocate the income of a low tax control entity to its parent company, whereby there is no, the directive and the implementation has ensured that there is no differentiation between a foreign subsidiary, a corporate entity, or actually a permanent establishment in a foreign jurisdiction. The EU, although they tried very much to get to a common understanding, unfortunately, even in the approach of the CFC rules, it was already difficult to get to such a common understanding, and therefore, eventually, the member states agreed to 2 different methods, and member states were free to choose either of the 2. Eventually, 14 member states chose to implement Model A. 10 member states chose to implement Model B. 1 chose to do a combination, which was the Netherlands. And 3 chose neither A nor B because member states were also free to decide to not implement either of the 2 models, to the extent that they were of the view that their national CFC rules, as already included in the domestic laws, already was sufficiently targeting the tax avoidance. So what's the difference between the Model A and Model B? Effectively, Model A works very much on the basis of reallocation of undistributed passive income. So that works on the basis of predetermined categories of so-called passive income, for example, interest, royalties, dividend, capital gains. Unless there is a substantive economic activity which is supported by, for example, staff, equipment, assets, and premises. This exception of the substantive economic activity for Model A is mostly in consideration with regards to EU CFCs. That is also on the basis of the Cadbury Schweppes case law we have, that there must be a wholly artificial arrangement for, in an EU context, to apply this. For non-EU CFCs, such substantive economic activity exemption was actually an optional choice. Not all member states decided to include that. Apologies. Model B is also referred to as the transfer pricing approach. So Model B works much more on the basis of undistributed income from non-genuine arrangements. For example, when the essential purpose is to obtain a tax advantage. And their only income is taken into consideration at the level of the parent company, to the extent that also the significant people functions in relation to that income are at the level of the controlling company, so at the parent company. As you can see, the list of countries that have introduced Model A and Model B. Model A was introduced by, for example, sorry, Germany, whereas Model B was implemented by Luxembourg. Looking at the overview of certain EU implementations, I chose for this presentation to focus mainly on Luxembourg, the Netherlands, Germany, and France, noting upfront that I am a Luxembourg tax advisor, so that is my home jurisdiction. The Netherlands I'm also aware with. France and Germany is really to provide you with an overview, but less of a detailed view. Sorry. So looking at the Luxembourg implementation, Luxembourg introduced, as mentioned, Model B, so the transfer pricing approach. There are two tests in Luxembourg when it comes to assessing whether or not a foreign entity or PE is a CFC. We have the control test and the low taxation test. A control test is that the Luxembourg company should hold direct or indirect participation of more than 50% of the voting rights, the capital, or the entitlement to profits of such entity or permanent establishment. The low taxation test refers to an effective tax of lower than 50% of the Luxembourg corporate income tax. For 2021, for example, that would be an effective tax rate of lower than 8.5%. And important to add there is that that should be considered, that effective tax rate, on the basis as if the CFC would be established in Luxembourg. So, for example, in case of dividends, if one of the income streams of the CFC is dividends, then it should be reviewed whether those dividends, if the CFC would have been a Luxembourg entity, would actually be exempt on the basis of the participation exemption. Another important note to make here is that Luxembourg has both a corporate income tax as well as a municipal business tax, and CFC rules have been implemented only for corporate income tax purposes. As per 1 January 2022, we will actually have an implementation of a correcting article in the law to ensure that also at a later stage, if there would be income, if there would be distributed income coming from the CFC, there is a correction taking place for municipal business tax purposes. So it's really the intention of the legislator to ensure that CFC is only applied for corporate income tax purposes. Luxembourg has, in addition, implemented both exemptions, accounting exemptions that were available for Model B. So if the CFC's accounting profits are lower than 750,000 euros, or if they're less than 10% of its operating costs for a given year, then there may be an exemption for the CFC application. Looking at the Netherlands made it incredibly difficult, mostly on the basis of PR. At the time of the implementation of the CFC rules, there had been a few state aid cases, and whereas Luxembourg, although it considered the state aid cases, it still decided that simply the implementation of Model B should suffice. The Netherlands wanted to go beyond that. The Netherlands, in that sense, argued that Model B is actually already included in their domestic legislation, because they already have the at arm's length principle firmly indebted in their domestic tax laws. And because of that at arm's length principle, they argued that you would never have a true Model B implication, because effectively any income already connected to significant people functions located in the Netherlands would be caught in the Dutch tax framework on the basis of the at arm's length principle. Therefore, they decided that in addition to having this Model B on the basis of the at arm's length principle, they also wanted to include Model A. They did include a substantial economic activity escape, which means that there is an escape for income derived from CFCs, which actually have, for example, 100,000 euros of own salary cost, have an own office, and have minimum substance. But that escape in terms of a substantial economic activity only is in relation to the burden of proof. So it is not necessarily an immediate exemption of a CFC application, but rather it puts the burden of proof for any abuse, and thus the application of CFC at the level of the tax inspector instead of at the taxpayer level. Interestingly, so the Netherlands, by including their Model A of the CFC, that doesn't look at the tax base per se, but rather at the blacklisted countries. So there you see that where in Luxembourg we would have a low taxation test, in the Netherlands there is a jurisdiction test. The Dutch Ministry of Finance publishes every year, as per the 1st of January of a given year, a specific blacklist. And furthermore makes reference to the European list of non-cooperative jurisdictions. This also means that you can have in a given year an addition to the European list of non-cooperative jurisdictions. If that happens on the 1st of March, you would only have an impact for Dutch CFC rules, to the extent that also on the 31st of December, that same jurisdiction is still included on the EU blacklist. So you may well have that a country goes on and off again in a given year, and then you will have no notice for Dutch CFC purposes. One addition though, on the control test, it's a similar test in the sense that it refers to a 50% holding. However, interestingly, for the control test, they refer to alone or together with an associated enterprise or person. Associated enterprise being 25 or more connection to the Dutch entity. And we will see a little bit later on that that may lead to significant issues with regards to double taxation, even for multiple Dutch entities. So not even within the Netherlands are you then free of double taxation on a specific CFC income. The low taxation rate, so the low taxation in addition makes reference to a statutory rate of less than 9% and not to the low taxation rate on an effective tax rate, such as, for example, Luxembourg. One additional point here, although for the rate, they look at the statutory rate, when it comes to the CFC income to be taken into account, so for the actual application of the CFC rules, then the income should be assumed on the basis of Dutch tax rules. So then actually you look back at, okay, how would that income be taxed under the Dutch tax framework? And that is then the amount that you can take into account. So also there, you would have a look at the dividends and whether or not Dutch participation exemption could apply to those dividends. Then giving a very brief update on the French and German rules. I chose France and Germany simply because they are one of the bigger jurisdictions within Europe. But I know, for example, that also Italy has quite strict CFC rules. So in that sense, there is definitely change or differences between the various European member states. France is one of those jurisdictions that actually already had CFC included since 1980. They have slightly amended those rules in 2019 and 2020 due to that implementation of the Anti-Tax Avoidance Directive 1. In France, they consider a little bit similar to Luxembourg, a control test where there is an ownership or a control for more than 50% by a French taxpayer. And also here, there's a low taxation test where you have a subjected tax to an effective tax lower than 50% of the French CAT rate. That would be due again on the basis of a similar tax base as would it be established in France. The French though have chosen not to do Model A nor B. because they have simply considered that the French company is then taxed on its pro rata share of the income deemed to be received from its PE or branch, or the actual distributed income from the subsidiary. France had, in addition, included some further considerations when it comes to distributions to entities located in a non-cooperative country. And non-cooperative country from a French perspective is any of the countries listed specifically in a list published every year by the French tax authorities. And there you may run into a 75% withholding tax on any payments to those jurisdictions. Although that, from a French perspective, that has always been included in the framework of the CFC rules, it is not per se an inclusion of undistributed passive income, and so should be viewed also from a separate perspective. Germany has actually introduced CFC rules since 1972, and initially had argued that no changes were expected on the basis of the Anti-Tax Avoidance Directive, because they had already sufficiently included CFC rules in their domestic legislation. Nevertheless, June of this year, the draft proposal was was voted in the Bundesrat, and the CFC rules will be slightly amended, although still very much similar as what they currently are. So from a German perspective, you look at three different aspects basically. A CFC is a foreign entity if it realizes passive income. And this is actually an interesting deviation when it comes to all other European jurisdictions, whereas normally CFC rules refer to passive income. Germany actually has a specific list of active income, and provided it is listed in that specific active income list, then you should be fine. If it is not in there, in that exhaustive list, then it should be considered passive income. So far, dividends and capital gains have always been included as active income. One of the bigger changes out of this new draft law, which should be applicable from 1 January next year, is that dividends would be excluded from the active income list in Germany, but capital gains most likely will remain on that list, interestingly. Germany furthermore has a control test with regards to also at 50%, but specifically a low taxation test, whereas the passive income has to be subject to a minimum taxation of 25%. Well, looking at all of the other jurisdictions, it is therefore quite easy to get into the CFC regulations of Germany, as 25% is quite high. Yeah, Germany has furthermore included a so-called motive test, and that allows it to prove that the CFC pursues an actual economic activity, but that only applies as far as its registered office is in an EU member state and is a direct result also of the Cadbury-Schweppes case law. Looking at the interaction with double tax treaties, and there, although I have listed both the Luxembourg and the Dutch considerations, there seems to be a European overall agreement on that, at least when it comes to CFC regulations, CFC rules for CFCs located in an EU member state. Because from a European perspective, EU law should always rank highest, and therefore CFC rules may always be applied regardless of any allocation of taxing rights on the basis of a double tax treaty. When it comes to a third country CFC, though, I will. That is an interesting discussion, and there you can have various technical arguments to argue that actually a double tax treaty should go should prevail over the CFC rules on the basis of the primacy of international treaties over domestic tax laws. And it is the domestic tax laws in which the CFC rules are included and in which the Anti-Tax Avoidance Directive is implemented. However, in practice, there seems to be a common approach also by various scholars, and well, especially tax authorities are very much in favor of that argument, of course, is that CFC rules should not be prohibited on the basis of a tax treaty. You can also see that, for example, by the commentary on the 2017 commentary, on the OECD Model Tax Convention, where you can, where it was included already that from the commentary perspective, there should be no harm in the CFC rules applying over the tax treaties. One of the technical arguments also being that a CFC taxation is levied at the level of the parent company, whereas the tax treaty actually applies on a company level or a branch level. Interesting discussion. Again, I think there are players in the market that argue that the treaties should should prevail, but I think in practice the likelihood of success on that argumentation is actually quite low. Let me just, so next one is really to show what I already mentioned in the beginning, that I think when it comes to Model B, generally speaking, you could argue that significant people functions for in relation to a certain asset are only executed in a specific jurisdiction. You could have some discussion there, which jurisdiction, some jurisdictions may argue similar, but generally speaking, you could get to an agreement on the basis of an actual transfer pricing review. When it comes to Model A, you could actually have more than double taxation, simply because of the strictness of the rules and the fact that you only look at the type of income and then the control. When it comes to a solution for a double taxation between European member states, in the first draft of the Anti-Tax Avoidance Directive, there was actually wording included there to mitigate double taxation, at least between an EU company, between various EU companies, but without further consideration, that remark was taken out in the final directive. So for now, that would mean that when you look at a structure as you currently see on the slide, you could have a CFC inclusion at the level of EU Go, given there is a 51% holding in CFC, provided, of course, EU Go has Model A implemented. When you then look at this from a Dutch perspective, and that specifically has to do with the fact that the Netherlands has included it on the basis of also associated enterprise, although there is only a 25% holding in EU Go, and thus if you would put the 25% to 51%, there is not a sufficient holding in CFC. Considering that the Netherlands argues that NLCO 2, so BV2, is associated to EU Go, NLCO 2 should similarly include the CFC income in its tax basis. Although NLCO 1 is also a Dutch BV, and you would thus imagine that NLCO One may consider the CFC income already taken into account as an ELCO 2. That is not the case. You have to establish also there a separate CFC income, and an ELCO 1 will include the same CFC income as an ELCO 2 and EUCO in its tax base. Perhaps really quickly, because then I realized that we're about to be out of time, at least here, just to show, and I won't go over the particular details here, just to show that how that low taxation test and control test can work out in different countries, where you have to look, and I think potentially Robin, part of the text here on the slide is missing, but that's okay, just for the audience to be aware. What is interesting here is that you look at the tax rate per jurisdiction, whereas Belgium and Luxembourg actually look at the effective tax rate. So for Belgium, you would be looking at the 50% of 25% tax rate, and for Luxembourg, you would be looking at 15% of the 18% tax rate. So in that sense, you can have a different conclusion in terms of CFC. And for the Netherlands, it makes no difference because you simply look at whether or not CFC is listed in in one of the lists as published by the Dutch Ministry of Finance. Now you see the text. Well, that is basically what I just tried to explain. Maybe going on then to the next one. Yeah. And that one is actually just to give a brief example of how this works in terms of low taxation and control test. And that ties in with what I just explained already in detail when it comes to the Netherlands. So Belgium and Luxembourg have very much a consideration of owning directly or indirectly over 50%. Whereas the Netherlands views this on an associated basis and thus is quicker to consider a CFC that it should be included in its own tax base. I'm just taking a little break to take a sip of water, apologies. And then I think a few questions came up. Sorry.
Yes, so let's get to the question. Thank you very much for this presentation. It was great. And getting on to maybe before we get to the question, I have just one observation that I found interesting is when you look at the Canadian rules as well as the European rules, you see that all the countries pretty much had the same policy. The policy rationale behind all the rules seemed to be very similar, but all the countries decided to adopt it in a different way. I think that ties up with one of the questions that I think is asked to Andrew, which is what is the policy rationale for treating certain income as taxable surpluses and certain other income as exempt surpluses? And that is in respect of the Canadian rules.
Right. So that's a great question because it kind of touches on some of the differences that you mentioned there. And I don't really want to speak for finance here, but I think there are some really good policy reasons for why these amounts are treated separately. So putting aside FAPI for a second, I really assume the question is saying, why is the DTC treated differently than the non-DTC? Remembering that active business income earned in a DTC can effectively come back to Canada free of additional Canadian taxation. And income earned in a non-DTC is treated as taxable surplus, and thus the distribution is somewhat more dependent on the foreign tax. I think kind of the first thing to look at is that a DTC includes treaty countries and tax information exchange countries, which generally suggests a certain level of cooperation with the Canadian tax authorities and information exchange, which allows Canada to look at those activities and verify that foreign income. That along kind of combines with the next point that perhaps this system is somewhat in place to encourage countries to form tax treaties or tax information exchange agreements with Canada. It also kind of suggests that if Canada is willing to enter into a tax treaty with this country, that there's some acceptance of their tax system. Obviously, entering into a treaty doesn't necessarily change it, but in the negotiation process, there's got to be some consideration of what that foreign tax system looks like. And then kind of the last point is that Canada, I think, generally wants foreign affiliates to be competitive. It wants them to be able to go out into the world, invest, and bring those profits back to Canada. But what I think kind of stuck out to me, as I think was somewhat already highlighted, is the differences in approach. So one of the things that I think is very visible that Charlotte talked about is this kind of low tax threshold. Canada doesn't really have this explicit rate requirement in the same way that a lot of the EU CFC rules have, but kind of the way that it looks at how that income was earned and treats it as it kind of comes back to Canada in combination with the FAPI system, kind of replicates that, kind of speaking to the way that, you know, the goals are similar, but the implementation is very different. And then the other point there is that Canada doesn't really have a bad list, if you will. Canada more so has a good list system, and it says, you know, anything in the DTC is, quote, good and can generally be treated in a favorable manner, assuming the activities there are active. I guess, you know, one of the questions maybe for Charlotte is, you know, is it effectively being a low tax jurisdiction that puts you onto a, you know, a so-called European bad list?
Yeah, and that's a good point, Andrew. Indeed, generally, especially Model A works very much on the basis of a so-called bad list. In Model B, similarly, but what you see there is that you can work with the effective tax rate and then actually tie that in with the significant people functions that may or may not be present in a certain jurisdiction. So even if you fall within those, if you fall within a so-called bad jurisdiction and you fall below the effective tax rate, you could still be in a position that actually the income that is accrued at the level of the CFC should not be taken into account for the tax base of the parent company.
I think that kind of highlights another interesting point about transfer pricing, insofar that I think the CRA would very strongly agree that transactions between foreign affiliates have to be transfer priced, and transactions between affiliates in Canada have to be transfer priced. But our rules don't seem to turn on transfer pricing in the same manner that some of the European Union approaches do, which I think is an interesting distinction between Canada's approach and the EU approach.
Yeah. All right. With that, I think we're running out of time, so I'll have to cut you short. So thank you very much for this. Just before we go, I have 2 special announcements to make. The first one is the premiere, just so everybody on this call, the first one to hear that IFA will be hosting a virtual event with Philip Baker of Field Court Tax Chambers in London. And the topic will be Trends in International Tax Jurisprudence. And that will be held on February 3 at 11 a.m. Eastern Time. And all the IFA members should get an email shortly to let them know the details and how to register. The second announcement is on the IFA Canada Tax Conference that will be held this year in Toronto. That's going to be on May 16th and 17th. And it's going to be an hybrid event where some people will be allowed to go in person, while others will have the opportunity to just stay home and listen to the broadcast the same way that we're doing now. And then the third point is to remind you again of the event that we just talked about on Pillar 1 and Pillar 2 that will be held by IFA Global on November 29th, 30, and December 1st. So I think with that said, thanks a lot to everyone who attended. And at the same time, thank you to our 2 amazing speakers, as well as to my colleagues of the YIN International Network that helped organize this event.
Thank you.